Every generation has its bubble. The dot-coms in 2000, real estate in 2008, and now, artificial intelligence. Sam Altman himself, CEO of OpenAI, admits it. The AI boom could collapse, and this time, it's bigger, faster, and riskier than anything we've ever seen. Why artificial intelligence feels like the last big bubble. Every era finds a new obsession. Once it was the internet, then housing, and now AI. Even leading insiders admit the hype may have outpaced reality. VCs poured $192.7 billion into AI startups in 2025, shattering previous records. Meanwhile, the global AI market is already valued at around $371.7 billion this year, with forecasts pointing to over $2.4 trillion by 2032. That doesn't include the speculative halo effect, hardware, infrastructure, derivative bets, sometimes estimated in the hundreds of trillions. Some analysts call it a $344 trillion universe of promise waiting for delivery. Take NVIDIA. In fiscal 2025, it reported $130.5 billion revenue, up 114% year-over-year. That level of concentration means the bursting of this bubble could drag down whole economies, not just startups. Here's where it gets dangerous. Bubbles form when belief outruns reality. Altman called today's AI boom a kernel wrapped in excitement. When expectations outrun capability, corrections begin at the margins. One disappointing earnings report, one failed project, one lost partnership, and then the dominoes fall. If this really is the biggest bubble ever built, how high can it go? And how fast can it collapse? Let's turn the page and see where the real risk lies. Debt, leverage, and the financial foundation of the boom. Every boom has a hidden cost, and this one is being paid with borrowed money. In 2024 alone, AI investment shot past $252 billion, a jump of almost 45% in a single year. But most of it wasn't funded by profits. It was financed through cheap credit and corporate debt that piled up quietly in the background. Tech firms have been taking out loans like there's no tomorrow. Many use vendor financing, paying chip makers like NVIDIA later, betting that new funding will cover the bills. In theory, it's smart leverage. In practice, it's a house of cards. The average debt-to-equity ratio in AI infrastructure companies has climbed above 1.4 compared to 0.6 a decade ago. When borrowing doubles, so does risk. The pattern is familiar. In the early 2000s, dot-com startups burned investor money faster than they could make a dollar. They borrowed to grow, until growth stopped. In 2008, homeowners did the same. They borrowed against tomorrow, sure that prices would rise forever. Here's the twist. AI's debt runs deeper because it's tied to everything, from cloud servers and data centers to chip supply chains. When interest rates rise by even 1%, the industry's total debt servicing cost jumps by tens of billions instantly. That's the fragility no one talks about on stage. Many investors assume governments and central banks will step in again, as they did in 2020. But what happens when even they can't print enough to rescue a $300 trillion system built on expectation? The cracks start small. A missed payment here, a failed startup there. But every crack whispers the same warning. What happens when the promise costs more than the profit? And that question leads directly into the next problem. The growing gap between what AI promises and what it actually delivers. The promise versus the delivery gap. Every boom begins with a promise that feels unbreakable. This time, it's that artificial intelligence will change everything. Faster, cheaper, smarter. But under all that noise, the numbers are quietly disagreeing. According to MIT research, more than 60% of corporate AI projects never reach deployment. They stall in pilot stages because they're too costly, unreliable, or simply don't deliver enough value. A 2024 AP report found that some firms spent millions on AI upgrades that actually slowed down productivity. That's not a glitch. It's the hidden gap between promise and delivery. Take self-driving cars. Billions were poured into them since 2015, yet we're still manually steering in 2025. Or chatbots, once promoted as job replacements, now being quietly retired in customer service departments because of error rates and bias complaints. The hype always sounds louder than the math underneath it. The danger comes when money stops following performance and starts following stories. Investors now value some AI startups higher than established industrial firms that actually turn profits. OpenAI's rumored $500 billion valuation is higher than ExxonMobil and Coca-Cola combined. But how much of that is justified by real revenue? Here's the catch. When innovation turns into narrative instead of numbers, the damage spreads fast. In 2021, dozens of AI for everything startups raised capital with no finished product. By 2024, over a third had vanished from the market. This pattern feels familiar. The same way Pets.com burned through $147 million before going broke in the dot-com era. Eventually, reality walks in, and expectations can't pay their rent. The question now is, who will run out of air first? The investors or the illusion? And the answer lies deeper in how money itself stopped telling the truth. When price signals fail and bubbles form. Money is supposed to speak the truth. Interest rates tell you when capital is scarce. Prices show what people really value. But for years now, that language has been rewritten. Central banks kept money cheap, credit easy, and investors drunk on liquidity. Therefore, risk stopped feeling risky. When the US Federal Reserve held rates near zero for almost a decade, it trained a whole generation of investors to believe borrowing was free. The result was predictable. Every dollar chased the next big thing. In 2024 alone, nearly 70% of venture funding rounds in tech were AI-related. Even non-tech firms began adding AI-powered to their pitch decks just to raise money faster. This echo of history is hard to ignore. Before the 2008 crash, cheap mortgages created a housing bubble. Before the dot-com crash, easy IPO money inflated website valuations that had no profits. Now, low rates and blind optimism are inflating everything tied to artificial intelligence, from GPUs to data centers to entire tokenized AI stocks. NVIDIA's dominance proves the distortion. Its market cap, once below $300 billion in 2020, crossed $4 trillion in mid-2025, more than the GDP of Germany. Investors treat chips like gold, but supply chains are tightening, and margins are thinning as competitors flood in. However, the price still climbs because no one wants to miss the ride. That's the real symptom of a bubble. Logic gets replaced by FOMO. Even Wall Street analysts are whispering that AI financing is starting to loop back on itself. Firms borrowing to fund clients who are also borrowing to buy their services. It's circular, and that's dangerous. When interest rates start to bite, the whole system begins to wobble. And that leads us straight to the question everyone's afraid to ask. What will actually make it fall apart first? The breaking point. What could trigger a collapse? Every bubble looks unstoppable right before it bursts. There's no warning bell, just quiet pressure building behind the curtain. The AI boom feels the same. The question isn't if it breaks, but which domino falls first. Some experts point to regulation. Governments are already circling. The EU's AI Act passed in 2024 with strict compliance costs, forcing hundreds of startups to shut down or relocate. In the US, the FTC is investigating AI monopolies, and Congress is debating model licensing. A single new law could wipe billions off valuations overnight. That's how the dot-com bubble cracked. Not with failure, but with regulation. But others say the real danger comes from energy. Training large AI models like GPT-5 requires millions of kilowatt-hours per month. Microsoft's data centers in Iowa alone consume enough power to light 500,000 homes. As energy prices climb, profit margins thin fast. The world is already short on chips, water, and power, a trifecta that can choke AI growth instantly. Then there's debt. The global tech sector borrowed heavily during years of near-zero interest. Now, with rates above 5%, refinancing that debt gets brutal. One failed funding round can cascade into layoffs, canceled contracts, and forced asset sales. We saw this in 2000 when over 5,000 internet startups collapsed within 18 months. Bank of England analysts have already flagged that AI valuations look dangerously stretched, echoing 1929's investor mania. If sentiment flips, say a major company misses earnings or a model scandal erupts, markets can unravel in days. And because AI money is woven into every sector, from chips to cloud to retail automation, one crack can pull the whole economy with it. Yet the real twist isn't how it crashes, but what happens after. Because every collapse from the railroads of the 1800s to Silicon Valley in 2000 leaves something behind, a skeleton on which the next boom grows. Which brings us to the final question. Who survives to rebuild once the noise fades? How to survive the burst and rebuild from the ashes. Every great boom ends with two kinds of people, those who lose everything and those who quietly rebuild while the dust settles. The AI bubble will be no different. Therefore, the real question is not who made the most during the rise, but who will still be standing after the fall. History repeats that pattern with precision. After the dot-com crash in 2000, Amazon's stock fell 90%. Most investors fled, assuming it was finished. Yet by 2008, it had multiplied tenfold because it had one thing others lacked: real revenue. The same was true after the 2008 crash. While mortgage-backed giants collapsed, companies with cash flow and discipline, like Apple and Berkshire Hathaway, emerged stronger. That's why fundamentals matter more than hype. The survivors of every bubble share a common trait. They produce something useful. In the coming AI reset, firms that truly improve productivity, from chip makers like TSMC to applied AI in logistics and medicine, will endure. Meanwhile, those selling buzzwords without profit will vanish as fast as they appeared. Even now, smart money is quietly shifting. Institutional investors are diversifying into infrastructure, real assets, and low-debt industries. They know credit will tighten once rates bite again. Yeah would have nodded here. Value always flows back to those who create, not those who speculate. But there's another layer. Individuals can survive this too, by avoiding leverage, holding assets that produce real cash flow, and resisting crowd hysteria. It's what Warren Buffett means when he says, "Be fearful when others are greedy." AI may crash hard, but it will also clear the field for the next builders, the patient ones who understand cooperation, capital, and time. Every reset leaves new ground for those ready to plant again. And somewhere in that silence after the fall, the next trillion-dollar idea will start small, built not on hype, but on hard value. Thanks for watching till the end. You're officially part of the curious few who dig deeper. If you enjoyed this breakdown, hit subscribe, drop a like, and keep exploring the next story, where today's data becomes tomorrow's history.